This video discusses net operating loss deductions, the taxability of Social Security benefits, and their impact on Roth conversions. I received a net operating loss carryover from a relative who owned a business which went to an estate trust and took several years to close. When I tried to compute my federal income tax for 2024, I found IRS Form 172 and its instructions to be confusing and incomplete, especially when connected with the taxability of Social Security benefits. Online advice on the interactions of NOL deductions and Social Security benefits were usually some vague inductive process which might not lead to the correct answer. I decided to make a video demonstrating that a simple graph explains the process easily. So let me begin with some disclaimers. This is not financial, legal, or personal advice. I'm not an attorney, CPA, or other type of advisor. IRS rules and procedures and determinations by courts might take precedence over a simple reading of the Internal Revenue Service forms and instructions considered here. I'm a mathematician, and I'm exploring the mathematical implications of certain Internal Revenue Service forms and instructions related to net operating loss, the taxability of Social Security benefits, and Roth conversions. You should do your own research and independently verify the accuracy of any information provided here before making use of this information. You should always consult a financial or tax expert before making any significant financial decisions. The Social Security Benefits Worksheet in the instructions to Form 1040 and 1040 SR is used to determine which part, if any, of a taxpayer's Social Security benefit is taxable. So we'll use some variables here. S is the total Social Security benefit, and Y is the taxable part of this benefit. Let I be the modified adjusted gross income as determined by the Social Security Benefits Worksheet. So this is going to be 1/2 of the Social Security benefit plus all the usual sources of income minus any adjustments from Schedule 1 and then plus non-taxable or tax-exempt interest. D1 is going to be $32,000 if a couple is married filing jointly, and $25,000 otherwise. And D2 is $12,000 for a married couple filing jointly, and $9,000 otherwise. There's an exception to this. For a married couple filing separately, which live together for at least one day in 2025, which is the year we're considering, those numbers are not correct. In fact, I believe D1 and D2 are both 0 in that case. So according to the Social Security Benefit Worksheet, here's the formula for the portion of your benefit that's taxable. But it's much easier illustrated using this graph. Here Z is the net operating loss deduction. Now in Schedule 1, line 8A, that's input as a negative number. So Z is a negative number. So if you consider the NOL deduction as a positive number, then Z is the negative of that. On the other hand, Z is bounded by, or the NOL deduction is bounded by 80% of income. And we also define a variable L, which we'll see in our graphs in a minute. So the constraints on Z and Y are these three inequalities. These three inequalities, the first one represents the 80% limitation of NOL deduction on income. The second one is the fact that people don't have an unlimited NOL carryover. So M is the amount of your total NOL carryover that you can use. And the last one is the fact that only a maximum of 85% of your benefit can be taxable. So this looks a little bit complicated, but in a graph, it looks like this. The line going from the lower right to the upper left and having a slope of -5/4 or -1.25 represents the 80% limitation of the NOL deduction. The vertical line where Z equals -M is simply the amount of your NOL carryover. You can't deduct more than you have available. And the top line is the 85% limitation. You go a maximum of 85% of your benefit can be taxable. So to put these two things together, we just put these two graphs together. And the part where they overlap, that is the red curve, is the relationship between Y, which is the portion of your benefit that's taxable, and Z, which is your NOL deduction, or the negative of that. You can see that the highest point on the red curve is where the most of your benefit, most of your Social Security benefit is taxable, and the lowest point on the red curve is where your minimum value is. So this is a relationship between the NOL deduction and the taxability of your Social Security benefit. Now, I can find a variable n. What n represents actually is the intersection of the red line, or the red polygonal curve, with the slant with the line with slope minus 5/4, which represents the 80% limitation on income. And you can see that the taxability of your Social Security benefit is minimized when your NOL deduction is the minus the NOL deduction is the maximum of minus M, which is minus your NOL carryover, A, which is D1 minus your modified adjusted gross income, and N, which is where the red curve hits the slanted line, this graph. So let's look at some examples. In 2025, Tom received $45,000 in Social Security benefits, withdrew $6,000 from his traditional IRA and $15,000 from his 401k, and converted $5,000 from his traditional IRA to his Roth IRA. He has a net operating loss of $50,000 from 2024. Tom is 69 in 2025 and files as a single taxpayer. How much of his Social Security benefit is taxable for 2025? Well, if I take half of his $45,000 benefit and I add his other income sources, I get $48,500. His Social Security benefit was $45,000. D1 was $25,000, D2 was $9,000, and M, which is the amount of his NOL carryover, was $50,000. So without his NOL carryover, $16,825 of his $45,000 benefit would be taxable. And here A is minus $23,500, B is minus $14,500, and L is minus $26,000. So you can see that there's a formula for how much of his benefit is taxable. Or I can look at the graph. So you can see in this case that depending on his NOL deduction, the amount of his benefit, which is taxable, is given on the red curve. And you can see it's minimized when the red curve gets as close as possible to A. And in fact, if we go through the details, we see that his NOL deduction is $21,571, and $965 of his $45,000 Social Security benefit is taxable. But looking at it as a graph simplifies the understanding tremendously, in my opinion. Let's look at another example. In 2025, Gene received $35,000 and Dave received $25,000 in Social Security benefits. They earned $100,000 in W-2 wages and had interest income of $2,000. They had an NOL carryover of $60,000 and long-term capital loss of $15,000. They're both 68 and filed as married, filing jointly. How much of their benefit is taxable? If we compute their modified adjusted gross income, we get $129,000 because they get half of $60,000 would be $30,000, plus their $100,000 income would be $130,000, plus their interest income makes $132,000, and then minus $3,000 because there's a $3,000 limitation on long-term capital loss deduction for ordinary income. So they have $129,000 in modified adjusted gross income. Their Social Security benefit total was $60,000. D1 was $32,000, D2 was $12,000, and their NOL carryover was $60,000. Without an NOL, net operating loss deduction, 85% of their benefit, or $51,000, would be taxable. However, if I look at a graph of their situation, you can see that by having an NOL deduction, they can reduce the portion of their Social Security benefit which is taxable. In this case, they don't have a large enough NOL carryover to get to the line, the slanted line representing the 85% limitation. In this case, you can see that the red curve is lowest down, closest to the horizontal axis, when M is $60,000, or minus M is $60,000. And in this case, $27,250 of their benefit is taxable. So by having the NOL deduction, they go from having to add $51,000 to their taxable income to having to add only $27,250 to their taxable income, which should reduce their taxes significantly. Let's look at another example. In 2025, Donna received $40,000 in Social Security benefits and $30,000 in pension income. She had an NOL carryover of $150,000, and she's 80 years old and files as a single taxpayer. How much of her benefit is taxable? Well, in this case, we take half of her $40,000 or $20,000 and add that to her $30,000 pension income to get $50,000. That is her modified adjusted gross income. Her Social Security benefit was $40,000. D1 is $25,000, D2 is $9,000, and M is $150,000. So without an NOL deduction, $18,100 of Donna's benefit would be taxable. If I look at a picture of a situation, you can see that the red curve almost touches the horizontal axis. If it did, then she would have none of her benefit would be taxable. And in fact, if we go through the computations, we see that her NOL deduction is $24,286, and $357 of her $40,000 benefit would be taxable. In my opinion, seeing this as a graph makes the whole situation much easier and simpler. Now suppose that you either have an NOL deduction or you're receiving Social Security benefits or both, and you want to do a Roth conversion. Well, understanding how the amount of your NOL deduction, the amount of your Social Security benefit that's taxable, and will affect how much you want to do a Roth conversion. The more you convert, the larger income, and therefore potentially the larger your NOL deduction, and also the more your Social Security benefit will be taxable. Now, before using this information to do Roth conversion, you should consult with an appropriate tax professional. Let's go back to Tom. Let's consider his situation and determine his tax liability without a Roth conversion and the effects of his on his tax liability of Roth conversion. So he's already done a partial Roth conversion for $5,000 earlier. So we assume he's already determined that. What if he wants to consider making an additional Roth conversion? So without doing a Roth conversion, his income was $5,394. His standard deduction will easily wipe that out, and he'll have no tax liability for 2025. But suppose he wanted to make an additional $10,000 Roth conversion. That would raise his modified adjusted income from $48,500 to $58,500, would change L and A and B. And you can see that there's a formula here which would determine how much of his benefit is taxable. But once again, if we look at the figure, then we can see that his NOL deduction will be somewhere between the points A and B. That the red curve doesn't quite get down to the horizontal axis. So some portion of his benefit will be taxable, but it'll be pretty small. And if we go back through the numbers, we see that his NOL deduction is $30,143, and $1,679 of his Social Security benefit will be taxable. His total income would then be $7,536, and his standard deduction would wipe that out, and he would have no tax liability. So by using his NOL deduction, he's able to convert an extra $10,000 from a pre-tax retirement account to a Roth IRA without having any tax liability. And once again, I believe this figure makes things much clearer than the instructions that the IRS provides. Let's consider another example. Ann doesn't have an NOL carryover, but she did receive $14,000 in Social Security benefits. She's 68, earned $20,000 as W-2 wages, and filed as a single person. What's her tax liability? And how would Roth conversions in 2025 have affected her liability? Well, half of her $14,000 benefit is $7,000, and add that to her $20,000 in wages. Her modified adjusted gross income, that is I, is $27,000. D1 is $25,000, D2 is $9,000, M is 0 because she doesn't have an NOL carryover. If she files her Form 1040 SR, $1,000 of her $14,000 benefit is taxable. Her adjusted gross income is $21,000. Her standard deduction is $17,750. Her Schedule 1A deduction is $6,000. And her tax liability is 0 because the sum of the $17,750 plus $6,000 is greater than her $21,000 income. Now, we could plot the variable y, which is the taxable portion of her benefit, as a function of a, which is 25,000, it was D1 minus I, 25,000 minus her modified adjusted gross income. Without a Roth conversion, a is minus 2,000. Suppose Ann wants to know how much she can convert from her traditional IRA to a Roth IRA and stay in the 10% marginal tax bracket. Well, for a single person, the 10% tax bracket tops out $11,925. So her income, and then taking into account her standard deduction or Schedule 1A deduction, has to be below $35,675. Her adjusted gross income is the $20,000 that she earned, plus the taxable portion or Social Security benefit, plus A4. Now that's the amount she wants to convert. On Form 1040, line 4 has her IRA cash distributions. That's what she's going to use for her Roth conversion. You can see that there's 3 formulas depending on the value of A4. So if I go to solve her income, 20,000 plus Y plus A4 is 35,675. We'll take the bottom formula, put in the maximum 11,900 for Y, and see what we get. Well, that implies A4 is $3,775. But if I plug that value in for Y, I don't get $11,900. So that's the wrong formula. So we have to use the middle formula. So we replace Y by $4,500 minus 0.85 times 7,000 minus A4. And if we solve that, we get A4 is $9,257. Here's a graph illustrating the situation. A goes further to the left as we do a larger conversion. And if she converts $9,257,000 from her IRA to a Roth IRA, then she stays within the 10% marginal tax bracket. Thank you.